If you have just packed up your life in Dubai, London, or the US and moved back to India, you are probably feeling a very specific kind of sheer panic right now. The fear of having your global wealth suddenly drained by the Indian tax system. You've spent years, maybe decades, building up this nest egg overseas, and the moment you step foot back in India, it feels like the tax authorities are just waiting right at the arrivals gate. I actually hear the exact question you're seeing right now all the time. People are terrified. They think that the switch from being a non-resident Indian back to a resident means an automatic, immediate tax on every single dollar, pound, or dirham they've managed to save. And hey, if you're feeling this anxiety, you are definitely not alone. We're talking about anywhere from 500,000 to 700,000 NRIs returning to India permanently every single year. And they aren't coming back empty-handed, right? The average returning NRI brings back anywhere from 50 lakhs to over 5 crores in foreign assets. That is a massive amount of wealth generating foreign income, whether that's from overseas pensions, rental properties abroad, or just foreign bank interest. The stakes are incredibly high, and the fear of losing a huge chunk of that to taxes in year one is a massive pain point for hundreds of thousands of returning Indians. But what if I told you there's actually a hidden transition buffer built directly into the Indian Income Tax Act, one that is designed exactly to protect your foreign savings while you settle in? It's not some shady offshore trick. It is a perfectly legal, heavily underutilized provision under Section 6 of the tax code. The crazy part is, most returning NRIs are completely unaware of this status, and they end up unnecessarily paying Indian tax on their global income the very first year they return. Well, we're going to fix that today. Welcome to this explainer. Today, we are going to completely demystify the tax rules for returning NRIs. We'll break down exactly how you can legally shield your foreign wealth so you don't surrender your hard-earned money for no reason. We'll be looking really closely at a specific residential status known as RNOR. And by the end of this, you'll know exactly how to leverage it to protect your global assets. Okay, let's take a quick look at our roadmap for today. First, we'll cover the returning NRI tax trap. Second, eligibility, the number game. Third, real-world savings and exemptions. And finally, myths, mistakes, and compliance. Let's dive into part one, the returning NRI tax trap. So here's the thing that trips everybody up. India actually has 3 tax categories, not just 2. Most people only know about being an NRI, where you're only taxed on India-sourced income, or being an ROR, which is resident and ordinarily resident, where your global income is fully taxed. But that middle category, resident but not ordinarily resident, or RNOR, that is the secret weapon we need to focus on. It's the missing link that most tax advisors skip right over when you move back. Think of RNOR purely as a legal transition shield. Seriously, commit this definition to memory. When you hold RNOR status, which is usually for a 2 to 3 year period after returning, you get the absolute best of both worlds. You're treated as a resident for everyday logistical stuff like opening bank accounts or buying a house. But, and this is the kicker, the government taxes you exactly like an NRI. That means your foreign income remains completely exempt from Indian income tax while you transition your life back home. Moving right along to part 2, eligibility. This is really just a numbers game. So the absolutely crucial point is, how do you mathematically prove you qualify for this buffer? Well, it's a 2-step process based entirely on your day count in India. First, you have to trigger basic resident status for the financial year. That usually means crossing the 182-day threshold in India. But becoming a resident doesn't mean you lose your shield. To unlock the RNOR buffer, you just need to meet either Condition A or Condition B. Condition A requires you to have been a non-resident in 9 out of the 10 previous financial years. Or there's Condition B, which requires you to have been in India for 729 days or less over the preceding 7 financial years. Basically, if you've been living abroad for a solid decade and you move back, you almost automatically qualify for this RNOR status for your first 1 to 3 years back in the country. All right, part 3, real-world savings and exemptions. Let's get into the fun part. This breakdown brilliantly illustrates the high contrast of the RNOR shield. Any income you generate inside India, like an Indian salary, local rental income, or capital gains from Indian stocks, yep, that's fully taxable. But look at these incredible exemptions. During your R&R period, your NRE fixed deposit interest, tax-free. Your foreign salary or overseas pension, not taxable. Rent collected from a property you still own back in Dubai or London, untouched. Even capital gains from foreign markets and your overseas bank interest are completely shielded from Indian taxes. Let's anchor this in reality with a quick example. Look at this timeline for Priya.
Priya worked in the UK for 12 years and decided to return to India in October 2022. Now, for that specific financial year, 2022 to 2023, she was only in India for 150 days. Because she didn't cross that 182-day mark, she legally remained an NRI for that first year. Then, in the next two financial years, 23-24 and 24-25, she was in India for over 250 days. She became a resident. But because she had been an NRI for the previous 12 years, she easily met that 9 out of 10 years rule we just talked about. So she secured RNOR status for 2 full financial years. It isn't until the 2025-2026 financial year that she finally becomes a full ROR, where her global income actually gets taxed.
And why does Priya's timeline matter to you? Because she understood the day count rules, Priya legally shielded her UK pension of £1,200 a month from Indian taxes for those 2 RNOR years. By claiming this status correctly, she saved a staggering 7.5 lakh rupees over 2 years, money that she would have otherwise surrendered to income tax. That is real wealth preserved simply by checking the correct box and understanding your transition buffer. Which brings us to part 4, myths, mistakes, and compliance. We need to shatter a massive misconception right now. The myth is that your tax status just magically flips to resident the very moment your plane touches down in Mumbai or Delhi. That is completely false. The fact is, residential status is not calculated on a daily pro rata basis. It resets every single year on April 1st, and it's based entirely on your total day count for that full financial year. You could land in December, live here for 3 months, and still legally be an NRI for that specific financial year just because you didn't hit the required day count.
And here is another incredibly common trap. You go to your chartered accountant, they look at your days, and they say, yep, you're a resident now, time to pay tax on everything. If this happens, you have to push back. Being a resident is just step 1. It does not automatically mean you're an ROR paying global taxes. You must specifically self-assess and verify if you qualify for R&R. A lot of standard tax software just defaults to ROR, and checking that wrong box means you are actively volunteering to pay excess taxes on your foreign wealth. Now, to make sure you don't face penalties, you have to stay rigidly compliant. First up, file your income tax return by July 31st and legally self-assess your status as RNOR right there in the form. There's no special separate application. Second, under RBI rules, you can't keep holding standard NRE accounts forever once you become a resident. You've got to convert them to resident or RF accounts within a reasonable time. Pro tip, keep all your old passports and boarding passes. If the tax authorities ever question your RNOR claim, those physical day counts are your absolute proof. But listen closely, here is the most crucial compliance trap of all. Schedule FA. You absolutely must declare all of your foreign wealth, bank accounts, properties, stocks in Schedule FA of your ITR. Even though the income from these assets are perfectly tax-free under RNOR, hiding the assets themselves is a major violation. You have to disclose them. So as you prepare for your return to India, or if you've recently landed, you really need to take a hard look at your timeline. Have you properly counted your days across the last 10 years? Don't let a simple misunderstanding cost you the wealth you worked so hard to build overseas. Honestly, it makes you wonder, if a perfectly legal transition shield like RNOR is this heavily underutilized, what other blind spots might be hiding in your global financial footprint as you move across borders?